Welcome back to Talk Tickers. It is Thursday, January 29th, 2026. And if you're looking at your portfolio this morning and just scratching your head, you are definitely not alone. Today, we are unpacking the Manhattan Associates Q4 2025 earnings. The ticker is MANH. And frankly, looking at the chart action over the last 24 hours, this feels less like finance and, I don't know, more like a psychological thriller for investors.
It really is. It's a classic case of what you might call market gaslighting, isn't it?
Yeah, how so?
Well, you had the call late Tuesday afternoon. The numbers hit the wire. They beat on the top and bottom line. And the stock, it pops nearly 5% in the after-hour session.
Right. Everyone's celebrating.
Everyone's popping champagne. Then the sun comes up on Wednesday. The real market opens, and the stock does a complete U-turn, sells off sharply, and closes down about 5%.
That is a 10-point swing in sentiment in less than 12 hours. Usually when you see a sell the news event like that, it turns out the news was actually, bad or at least mediocre. But I've looked at these numbers, and on the surface, they look pristine. So our mission today is pretty simple. Is this just valuation vertigo people getting scared of the price tag, or did the algorithms find a crack in the armor that the headlines missed? I think that's exactly it. We need to ignore the press release euphoria and look strictly at the guidance and the internal mechanics. Because while Q4 was a victory lap, the roadmap they laid out for 2026 has a few potholes the market didn't expect.
And the market is in no mood for potholes right now.
No, it punishes anything that isn't absolute perfection.
Okay, so let's start with that victory lap first, just to set the baseline. The headline, beat was legitimate. Adjusted EPS came in at $1.21 against a consensus of $1.11.
A 10-cent beat. In this macro environment, that is nothing to sneeze at.
No, it's strong execution.
And the revenue line was healthy too, $270.4 million, beating expectations by about $6 million. That's up almost 6% year over year. But for a company like Manhattan, you have to isolate the cloud revenue. That's the real engine, right?
Yeah.
Everything else is just noise.
It is the engine.
Yeah.
And it hit $108.6 million, up 20% year over year. If you're a bull on this name, that's the number you tattoo on your arm.
Right. So double-digit cloud growth, profitable, cash rich. So why the hangover? Why the big sell-off?
To understand the hangover, you have to look at the quality of the quarter versus the promise of the future. There were some metrics hidden in the supplementary data that are frankly astonishing.
Oh.
But they also paint a picture of a company that is shifting gears. Look at the RPO, the remaining performance obligations.
And just to clarify for anyone who might be new to SaaS metrics, this is the backlog, essentially.
It's the backlog, the money that is contractually guaranteed but hasn't been billed yet.
It's the crystal ball for future revenue.
Correct. It's the crystal ball for stability. Total RPO hit $2.2 billion. Yeah. That is up 25% year over year. That is a massive safety net.
And the cash flow backs it up.
Oh, completely. They generated $147 million in cash from operations in Q4 alone. For context, that's a huge jump from the $104 million they did a year ago.
So they are just printing cash, and they aren't sitting on it like a dragon on a gold hoard either. They bought back $75 million in stock in Q4.
And just reloaded.
Just reloaded the authorization for another $100 million in January. That usually signals management thinks the stock is cheap.
They're buying their own dip, which is, usually the ultimate vote of confidence. But here's where the narrative gets complicated, where I think the market got confused. On the call, the CFO, Dennis Story, he introduced a brand new metric. And whenever a CFO invents a new acronym during an earnings call, my antenna goes way up.
Because it usually means they want to direct your attention away from something else.
Exactly. They want you looking over here, not over there.
So what's the new buzzword?
Ramped ARR, or a 4-year annualized value of recurring revenue. It came in at over $600 million, up 23% year over year.
Okay, so play devil's advocate here. We already have revenue, cloud revenue, and RPO. Why do we need ramped ARR? Is this just financial engineering to make things look smoother?
That is exactly what it is, but I wouldn't say in a deceptive way. It's designed to hide the lumpiness.
Hide the lumpiness.
See, RPO is great, but it's volatile. If Manhattan signs one massive retailer, say a Target or a Walmart, to a 5-year deal in Q1, RPO just spikes.
Yeah.
Then if Q2 is just a bunch of smaller mid-market deals, RPO looks flat or even down sequentially. Ramped ARR is meant to show the steady heartbeat. It assumes no churn and no price increases. It's a floor.
So it's a message to investors. Relax. The baseline business is growing 23%, even if we don't sign a mega deal tomorrow.
Precisely. It's an attempt to calm the volatility. But speaking of volatility, there was one statistic in the customer mix that I found completely wild.
What was that?
Management mentioned that in 2025, 55% of their new cloud bookings came from net new logos.
Wait, 55%? That seems unsustainably high. Don't you usually want to balance?
It is incredibly high. The standard rule of thumb for a mature enterprise software company is the rule of thirds.
1/3 new, 1/3 cross-sell, 1/3 upgrades.
You got it. 1/3 new customers, 1/3 cross-selling to existing clients, and 1/3 converting old legacy systems.
So hitting 55% net new means they are aggressively just stealing market share. They're walking into rooms against SAP or Blue Yonder and winning more than half the time.
They are winning the war for new territory. But, and this is a big but, that the algorithms likely flag management explicitly warn that this is going to revert to the mean.
Oh, they said that out loud.
They told investors, do not expect 55% again. We are going back to the rule of thirds.
And that's the first friction point. The market hears normalization and it translates it as slowdown. Even if going back to 33% is healthy, it feels like a deceleration from the sugar high of 2025.
It feels like the party is winding down.
Yeah, exactly.
Investors project the current trend forward forever. When management says, actually, the trend will flatten, the valuation takes a hit.
Okay, but you said that wasn't the biggest reason for the sell-off.
No, not at all. The biggest reason was the strategic pivot. Manhattan is no longer just the supply chain company. They are betting the farm on agentic AI.
I feel like legally, every software company in 2026 has to mention AI within the first 5 minutes of a call, or they get delisted. But is this real product or just marketing slides? Because agentic AI sounds like, I don't know, a plot point.
It seems very real, mostly because of how expensive it looks to implement. They announced the commercial availability of Active Agents and Agent Foundry.
And we're not talking about a chatbot that summarizes your emails or writes a haiku.
No. These are agents embedded in the warehouse management system, the WMS, and the transportation management system, the TMS.
So an agent that can actually reroute a truck or reorganize a pallet line without a human clicking a button.
That's the promise. They're also rolling this out to the point of sale. Imagine a store associate having an AI whisper in their ear via a mobile device, saying, that customer just looked at the blue sweater, suggests the gray chinos because we have too much stock of them and they fit the same style profile.
That's powerful. That's essentially the commercialization of competence. But here's my skepticism. How do you get a logistics manager who has been running a warehouse the same way for 20 years to trust a bot?
Right. These aren't people who like change.
Not at all.
Well, that is the billion-dollar question. And Manhattan's answer seems to be brute force. Their go-to-market strategy involves 90-day pilots. But to ensure those pilots work, they are deploying what they call forward-deployed engineers.
That sounds militaristic, like they're sending in special ops to the loading dock.
It's essentially a high-touch consulting model. They are sending human engineers to the customer site to hand-wire these agents, integrate the data, and make sure the pilot is a success.
Okay, I see the trap. Software is high margin because you write the code once and sell it 1 million times. If you have to send a human engineer to every single customer site,
your margins get crushed.
It destroys your margins.
Yeah.
Humans don't scale like code does.
Bingo. And that brings us to the guidance, which is where the stock price fell off a cliff.
The moment of truth.
The 2026 outlook for revenue is fine. $1.13 billion to $1.15 billion. That's roughly 5 to 7% growth. But the EPS guide, that was the cold shower.
They guided adjusted EPS to $5.04 to $5.20, which implies, what, flat to maybe 3% growth compared to 2025?
Flat earnings growth on rising revenue. Investors hate that leverage profile. But when you dig into why, it's because of those forward-deployed engineers.
The cost.
They hired 100 new services people in January alone.
100 people in 1 month. Yeah, a massive payroll increase for a specialized firm.
It signals confidence. They wouldn't hire them if they didn't have the pilots lined up. But in the short term, those salaries are a drag on profitability. 2026 is effectively a transition year.
A year where they spend heavily to prove the AI model works.
And Wall Street has zero patience for transition years. They want the growth and the margins right now.
There was also a nuanced point about contract duration that I think confused some people. Management said they're shifting from 5-year contracts to 3-year renewals.
This is a fascinating detail that I think the bears are misinterpreting. On the surface, it looks bad. You'd think you want to lock a customer in for as long as possible.
Right. A 5-year deal adds more to that RPO number we talked about. Optically, it makes the backlog look smaller.
Exactly. So why do it? Why voluntarily shorten your guaranteed revenue window? It seems like you're inviting churn.
So what's the logic?
Think about the macro environment and the product cycle. Inflation is still a factor. If I lock you into a fixed price for 5 years, I'm losing money by year 4 because my costs went up that your bill hasn't.
Okay, that makes sense.
But more importantly, if I'm rolling out these new AI agents that provide massive value, I don't want you locked in at 2025 prices until 2030. I want to renegotiate with you in 2029 so I can upsell you on the tech I haven't even invented yet.
That is actually incredibly bullish when you frame it that way. It means they are betting on their own product.
It's a huge bet.
They're saying, we know you're going to be so addicted to this AI that in 3 years, we can charge you more.
Exactly. It's a bet on sticky tech. It's playing offense, not defense. But the algorithms that trade these stocks, they just scan the transcript for contract duration and RPO growth.
They see duration decreasing and RPO growth decelerating, and they just hit sell.
They hit sell. They are targeting 18 to 20% RPO growth for 2026, which is a step down from the 25% they just posted. And that scares the momentum traders.
So if I sum up the bear case, earnings are flat because they are hiring an army of humans. RPO is optically slowing because they shorten contracts. And the AI revolution is still just a bunch of expensive pilots that haven't paid off yet.
That's a fair summary. Plus, add in the services revenue surprise. Services revenue came in over $120 million. That segment is growing again.
Why is growth in services bad? I mean, money is money, right?
Not to a software investor. Services are lower margin than software license fees. Software has, 80 to 90% gross margins? Services might have 30 to 40.
I see.
If Manhattan starts looking more like an IT consulting firm and less like a SaaS platform, the market will compress their valuation multiple. You don't pay 40 times earnings for a consulting firm.
So the market is having an identity crisis about the stock. Are you a high-growth software wizard or are you a labor-intensive implementation shop?
That is the tension. And looking at the macro, the IGV, the software ETF, is down 11% this month. The appetite for high valuation, low growth is just non-existent.
Yeah.
Manhattan has to fight the tide of the entire sector.
And we shouldn't gloss over the fact that they mentioned lumpiness about 10 times on the call. They even cited a $1.3 million headwind from a customer liquidation.
Yes, a bankruptcy. $1.3 million is a drop in the bucket for them, but it's a reminder that they serve retailers. And retail is a tough, brutal business. If the consumer economy cracks, Manhattan feels it immediately.
Okay, so we have a bull-bear standoff. The bulls see record cash flow, dominant market share, that 55% new logo stat is hard to ignore, and a clear AI strategy.
While the bears see flat profits and a valuation that leaves absolutely no room for error, it really comes down to your time horizon.
Right.
If you're trading for next quarter, the flat EPS is a deal breaker. You're buying dead money. If you're holding for 2028, the AI pivot might be the smartest thing they've ever done, and this sell-off is a gift.
This brings us to the part of the show where we stop being rational analysts and start getting creative. It's time for the "This is not financial advice" segment.
My favorite part.
As always, a massive disclaimer. We are just voices in your headphones. Do not trade on this. If you lose money, that's on you. We are here for entertainment and wild speculation only.
Purely a thought experiment. Let's hear what you've cooked up.
I'm calling this idea the forward deployed duration arbitrage.
That is a mouthful. It sounds like a chapter from a cryptic finance textbook. Break it down for me.
Okay, so let's connect the dots we just discussed. They're shortening contracts to 3 years to capture future pricing power. And at the same time, they're flooding clients with these forward-deployed engineers for 90-day AI pilots right now in Q1 and Q2.
Right, they're planting the seeds.
So the trade is a pair trade. You go long Manhattan Associates M&H June 2026 calls. You are betting that those Q1 and Q2 pilots convert into hard revenue by the summer.
So you're betting on the conversion rate.
Exactly. When they do, that ramped AR metric explodes in Q3, and the market realizes the flat guidance was a massive sandbag.
You're betting that if those engineers succeed, the revenue catches up to the expense quickly, and the margins expand in the back half of the year. What's the other side of the trade?
You short a basket of pure-play IT consulting firms. Think of the firms that usually charge retailers millions to optimize their supply chains manually.
Oh, I like that. You're betting on the automation of the consultant.
Precisely. If Manhattan's Agent Foundry works, you don't need a team of 50 consultants billing by the hour to figure out your shipping logic. You just need the software. I call it the Trojan horse hedge.
Okay.
You buy MNH for the software, but you're really betting on an army of engineers manually wiring up AI agents inside the Fortune 500.
It's cynical, but it tracks. Once those agents are embedded deep in the WMS, ripping them out is operationally terrifying. No CTO is going to risk shutting down the warehouse to save a few bucks.
You're betting on Manhattan becoming the operating system for commerce, not just a tool.
That's it. It's a bet on creating a sticky web that no one can ever untangle.
So if the pilots convert, the stock re-rates higher. If they don't, well, those June calls are going to zero. But that's why it's a deep dive idea, not a savings bond.
It connects the hiring spree to the contract duration change perfectly. They are taking the pain now, flat earnings, high costs, to secure dominance for the next decade.
So to wrap this all up, we have record RPO of $2.2 billion. We have a company taking 55% of the new deals in the market. But we have a stock that got punished because they decided to invest in their future rather than maximize next quarter's EPS.
The strategy is clearly invest in AI dominance now. The question for you, the listener, is simple. Is a 5% sell-off a buying opportunity for a best-in-class operator? Or is it a warning that 2026 is going to be a boring, flat year where your money is dead?
That is the question. With $330 million in cash and a management team buying their own stock, I wouldn't bet against them. But, as always, keep your stops tight and your due diligence deeper. Thanks for listening to Talk Tickers.
We'll see you on the next deep dive.